So I have to be honest with you guys. What we've seen today was not what I would call the greatest for markets. Yes, we bounced back a lot from the 1.5% negative S&P 500 at one point we were at. And now we're positive a 0.5%. But the leadership is very concerning to me. And I want to explain that to you here in this video. It could be forecasting or foreshadowing a weak market or a potential weak market that could be to come. Because big tech is outperforming today. And that's not what you would want to see, as we are just days away from the first Fed cut. Now, what does this mean for Tesla? I will contextualize this and put it into a little bit of context. What could be coming next for Tesla stock? And really, the problem is today, CPI came in higher than expected. That's not a huge problem right now because we know the Fed is going to cut rates coming September 18th. The problem is the market said this CPI report could prevent the Fed from cutting rates fast enough to avoid a recession. So what did you see happen today? You seen Nvidia up 7%, Meta up 0.5%, Google up 1%, Microsoft and Amazon up a 1.5% apiece, and Apple up 0.5%. Now, you guys might say, like, why is that negative? Why is that a bad sign for markets? And it's because we're back to the 18-month playbook that we had of big tech outperforming today. Now, one day is not enough to, make a trend, but all trends start with one day. You've heard that expression before. Big tech is seen as the 2020s recession trade. Back in previous recessions, the recession trade, the area that you'd want to be in, more of a defensive area, was healthcare and utilities and staples. Nowadays, it's big tech. So you've seen investors go out and buy big tech. That's not what you would want to see just days away from the first Fed cut and what subsequently would be a soft landing. Because let me tell you right now, big tech is not going to outperform if we truly have a soft landing. Now, if we go into a recession, if the Fed does not cut rates fast enough, big tech is going to outperform relative to other areas of our markets. And that's because most big tech companies are leveraged to other businesses, like Microsoft. They do most of their revenue with other businesses that are less likely to stop using Microsoft, compared to like a Nike that sells direct to consumer, that is dependent on consumers having jobs and being in a good financial place, so on and so forth. So that's why big tech is really deemed as, more recession resilient, kind of that defensive recession trade if we were to go into a recession. And within big tech, Tesla is also included in that. Now, Tesla is well underperforming compared to any of these other big tech stocks. That's because Tesla is not seen as a recession resilient company. Tesla is seen as a recession vulnerable big tech stock because of its direct to consumer business. The real problem here is recession trades are getting bought, which looks good for the markets. The S&P recovered a lot. The NASDAQ recovered a lot. What underperformed was your Dow, was your Russell 2000, the areas that in theory should benefit the most from the Fed cutting rates, because big tech does not benefit from the Fed cutting rates or a soft landing, right? Again, I've talked about this many times, but big tech takes in interest on their excess cash, which as the Fed cuts rates, they're going to get paid less. That's less bottom line profitability. It's going to be harder to meet earnings expectations, basically. The faster the Fed cuts rates, that is a burden to big tech. As, rates fall and as we do go into a soft landing, if that's what happens, then you really wouldn't want to own big tech there. They're not leveraged to interest rates. There's There's other areas of the markets that would benefit a lot more, like small caps and cyclicals and consumer discretionary. So preferably what you would want to see heading into a perceived soft landing by the markets, heading into the first Fed cut, in just days now, next week, would be an outperformance of small caps, would be an outperformance of value and of cyclicals. But instead, today's hotter than expected CPI report, which was 87% shelter, which shelter will fall when the Fed raises rates, you actually seen the recession trade get put on today. You've seen the areas that would benefit via a soft landing, cyclicals, consumer discretionary, small caps, they underperformed, which this is the recession playbook of the 2020s. Now, the recession playbook of the 2020s happens to be your big tech that dominates the S&P and the NASDAQ, weighting as an index. Again, it looks good on the surface, but when you ultimately do go into a recession or something along those lines, big tech's not going to be immune. We've seen that in 2022, and you can make an argument big tech earnings estimates for 2025 are way too high as is. So just, having these hard landing fears or whatnot is not going to keep the markets well. It is not going to send the market substantially higher from here, but it does kind of mask the reality of what we've seen today, which was the recession trade going back on. People buying big tech when you wouldn't want to see that if we're actually heading into a soft landing and the first Fed cut. Other hedge funds and institutions also pointed this out today, that upon the data release that we got this morning, the market said, oh crap, this hotter than expected inflation report is going to prevent the Fed cutting fast enough to avoid a recession. So what you ultimately seen when the data first came out was 10-year treasury yields dropped. And then they rallied back, which was a sign of just that. Now, as I've talked about many times now here on this channel, I really don't think CPI anymore is a big catalyst. I think economic data is the big catalyst. And we do have some of that coming tomorrow. Coming out tomorrow, we will get PPI month over month. You want to see this come in as low as possible, because the lower this comes in, really the bottom line, the less profit margin squeeze companies might feel. If PPI, producer price index, producer side of inflation, starts to outpace consumer price inflation, then that's going to squeeze margins. That's not going to be good. So as CPI comes down, you want PPI to come down faster so those margins don't get compressed. So that'll be important, expecting 0.1%, the same as last month. If we come in there, that would be seen as a positive. Initial jobless claims are expected to be 231,000. If we get a upside surprise there, that's obviously not going to be good for markets as well, since the focus is how strong is the economy and are we actually heading into a recession, or is this going to be a soft landing? Now, I think for Tesla stock specifically, we did recover a lot. At one point, Tesla is down over 3%. I think some of this has to do with just algorithms. When big tech goes up, a lot of other areas of the markets tend to go up as well. Tesla also went up a lot from the low of the day today, which was about $216 per share, up to about $226 per share. Overall, Tesla's still underperforming, but Tesla is back above that 50-day moving average, which is good. Now, if the economic data starts to come in good, if tomorrow's initial jobless claims comes in low, then I would want to see Tesla outperform. I would want to see small caps outperform. I would want to see value, high-paying dividends, and cyclicals and consumer staples outperform big tech. If that happens, then that is the soft landing trade. If we continue to start to see big tech outperforming, that's a sign that markets are pricing in some recession risk. Now, overall, markets are not pricing in a recession. It's still 0% chance of a recession. But I guess you could call it recession positioning. Would you rather be in Microsoft or Nvidia if we go into a recession, Or would you rather be in Nike or Restoration Hardware or Whirlpool or some of these consumer discretionary stocks? You'd rather be in Microsoft or Nvidia, okay, that do business really from corporation to corporation with not as much exposure to the average citizen's financial well-being, okay? And yes, Nvidia and Microsoft, they would be affected, but they would be affected less than Nike, than Whirlpool, than, some of these other, names that are vulnerable to a recession. Same with Tesla. Nvidia, that's up 7% today, is less vulnerable in a recession, theoretically, or Microsoft is less vulnerable during a recession than a Tesla would be. And that's what I find alarming about today with the inflation data that we got today and the Fed meeting coming next week. Preferably, you would want to see Tesla outperforming today. Again, that's not happening. One day is not enough to solidify a trend, but if this is a trend that we start to see again, it's going to be very concerning. Now, I do think September seasonally is just not great. October seasonally is not great. And I do expect there's going to be a larger kind of drawdown, a larger correction. If we do see weak economic data, that's going to be a problem. I would expect to see, big tech sell off. I would expect to see everything sell off, kind of like what we've seen recently. Tomorrow's initial jobless claims is a high frequency data point that some people think is a leading indicator of the labor market. It doesn't look like that has remained true in recent months, with unemployment insurance claims remaining pretty low and the unemployment rate rising. But nonetheless, this is all about recession or not, whether or not the Fed is too late or right on time cutting rates. And today, believe it or not, the markets are saying the Fed may not cut rates fast enough, so we want to own big tech. Because if we do go into a recession or slip closer to a hard landing, big tech is going to relatively outperform cyclicals, small caps, value, a stock like Tesla. So if we get better economic data over the next coming days, if initial jobless claims come in low tomorrow, then I think Tesla stock can do very well. You do have this cup and handle formation that looks to be almost fully formed now, at least on a near-term basis, which could send Tesla stock into, again, the 250s or 260s, even by the end of this week, by next week, or at least after the first Fed cut, as long as we take that as positive. We'll get a Fed dot plot. We'll get a couple of other things as well to give us more insight to, the economy and the Fed by then. I believe retail sales comes out next week before the Fed meeting also. So these are going to be important. It's really all about the economy at this point and whether or not the Fed is late or just on time to start cutting rates. If the Fed is just on time and it doesn't look like the economy is weakening, then Tesla stock's going to take off after the first Fed cut. If the latter happens and it looks like the Fed is late, then Tesla stock is going to sell off something fierce over the next couple of weeks. On a technical basis, considering the strength Tesla has shown recently, it would suggest that Tesla could actually rally over the next couple of weeks, but it's almost impossible to forecast what these data points are going to be, or if the Fed's going to give us a dovish or hawkish 25 basis point cut. And there's a lot of different things that are kind of happening all at the same time. Markets are focused on economic data. They're focused on the Fed dot plot and the first Fed cut, whether that's bullish or bearish. So many different things that it's hard to say specifically what's going to happen with Tesla. I would say, though, the odds are skewed in our favor as long as we're above that 50-day moving average. I would say probably a 65% chance of a large rally over the next couple of weeks, but there is that 40 to 35% chance of a large decline if things don't go right with the Fed, if the economic data disappoints the downside. Keep in mind what I was saying heading into September was I think the data is lagged behind So meaning the economy today, I think, is much worse than the economic data shows. I think we're actually seeing what the economy looked like months ago. So thus, I'm a little bit more concerned towards the end of this year and the start of 2025, what the economic data could look like. I think it's going to look worse, and I think that will spark recession fears towards the end of this year. But for September, I'm not super concerned still about the economic data. Question is, what happens with the Fed and how do markets position? And today, markets are definitely taking some of that recession trade and putting those chips back on the table. Not to a, extreme level. When the data comes in decisively bad, when it's obvious, like, hey, we're going into a recession, big tech will sell off, everything will sell off. But as there's kind of these uncertainties that maybe the Fed won't cut rates fast enough, that's seen as a temporary green light for big tech. When the recession comes, when the data starts to look very recessionary, everything will sell off. Let's be honest there. But right now, it's giving you hints of recession fears. So let me know what you think about this information down below in the comment section. Again, I still think September can be a strong month if we get a dovish Fed cut, if the dot plot doesn't look too bad, if the Fed's not signaling greater economic weakness, if retail sales come in good, or decent at least, then I do think September can actually be a good month, and I would be more concerned still for November and December's economic data. I think the holiday comps are going to be really difficult to beat from last year, and that's going to spark, I think, a whole new round of what could be recession fears for this market. So again, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.